Welcome to the Steps to Investing, What to Know Now webinar. This is part of the Get Savvy, Grow Your Green Stuff webinar series. My name is Andrea Pellegrini, and I run the University of Illinois Systems Student Money Management Center, and I'm joined today by my colleagues in the U.S. Securities and Exchange Commission. Alan, would you like to introduce yourself?
Sure, and thanks, Andrea, and the University of Illinois System for having us, the SEC, here. I am an assistant director in the SEC's Office of Investor Education and Advocacy. I've been at the SEC 2 different times in my career, but for a total of about 17 years, and with the federal government for about 25 years. Happy to be here to talk about investing, and I will hand it off to my colleague, Anne.
Hello, and thank you, Andrea and Alan. My name is Anne McKinley. I am an assistant director in the SEC's Division of Enforcement in the Chicago Regional Office. And my day-to-day job includes supervising investigations and litigation of possible securities law violations. I also co-chair our office's Military Outreach Committee, and I'm very happy to be here. So before we begin, I do need to give a disclaimer. We are providing information today for you as a service. This isn't a statement of official SEC or any other policy. It also isn't meant to be legal or investment advice. In addition, while I am providing remarks today in my official capacity as an assistant director in the SEC's Division of Enforcement, any remarks that I do make or that Alan makes do not necessarily reflect the views of the commission, the commissioners, or any other members of the SEC staff.
Thank you, everyone. I would just like to point out that collectively, the Get Savvy webinar team represents organizations across the state of Illinois, which rests on the ancestral lands of multiple Native nations, and we have a responsibility to acknowledge those nations and move with them towards a more vibrant and inclusive society. We'd also like to do a little poll, if I can launch it appropriately. The polls for demographics helps us to better understand who is joining us today. It also helps our colleagues in Extension, like Emily, who's helping to monitor the chat, to maintain funding for their outreach across the state of Illinois. And Alan and Anne, can you hear me okay? I had a private message that my audio keeps dropping out.
Now you sound fine.
Okay. All right, it looks like we have a large distribution in ages of people joining us today. We have students and full-time employees, as well as retired folks. A lot of women online today, and a pretty big variety of other demographics. I will end the poll. I'm going to share that real quick. And if you want to continue looking at it, you can. I'm going to stop sharing though. If it's still up, you can close out by exiting that window. For anyone that is having issues with hearing me still, it's probably on your end, since Alan and Anne are hearing me okay. So again, we like to produce learning objectives first. So the things that we're going to discuss today include creating a plan to start investing, understanding some of the risks of investing. We're going to identify a few ways to get started with investing, as well as explore investment strategies. And we're going to review ways of protecting your assets. So in creating a financial plan, we do need to understand a couple terms. Often people use the words saving and investing interchangeably. Ultimately, the financial products and services that cater to savings and investing differ on how risky they are and how much potential for returns there are. So for example, savings products might include putting money in savings accounts, money market accounts, certificates of deposit at banks and credit unions. These financial products have almost no risk of losing money, but returns tend to be very low. However, they're usually insured from loss if you have, for example, your money in savings accounts at FDIC or NCUA insured financial institutions. Example of investment products include stocks, bonds, mutual funds, etc., things that we will be talking about today. And the risk of losing money with investing can range from very low to very high. So it is possible that returns are going to be higher with investing focused products than with savings focused products. But the value can be kind of volatile and they're not insured. So that's something to keep in mind. The other thing to keep in mind is you can't just put all your money into savings or stick it under your mattress, because the money that you have today won't be the same or have the same purchasing power as what you would need later on. For example, you could have gotten the original iPhone over 15 years ago at about $600. But today, a top model iPhone would cost you almost double that. And that's the result of inflation. Investing is one of the best ways to try to cope with the impacts of inflation, which is why we're going to focus on it today. So investing is part of most people's financial plan. If you haven't already, you might like to watch our previous webinar, Investing Basics, where we talked about having a financial plan and introduced many of the important investment terms and concepts that we'll probably be talking about quickly today. Beyond setting your own financial goals, part of creating a financial plan requires awareness of your financial situation, including things like your debt and your assets, establishing emergency savings, paying down high interest debt, then researching investment options for your goals, and determining your risk tolerance and limits. So you definitely want to have these steps completed before you start actually investing or doing something like purchasing a home, for example. What is considered high interest when it comes to debt can vary from person to person or even among financial professionals. So right now, the average 30-year mortgage rate is over 7%. So if the interest you're paying on debt is above 7%, you'll probably want to prioritize paying that down before getting into investing. Some other tips you want to keep in mind when paying down high interest debt is you want to pay more than the minimum. You might want to use the debt avalanche method or the debt snowball method to expedite paying off your debt. You'll pay the least amount of interest using the debt avalanche method, since you kind of prioritize paying more than the minimum on your highest interest debt. But some people are easily more able to maintain motivation a little bit better with the debt snowball method, since you pay off the lowest balance debts first. So another thing to keep in mind, if you have federal student loans, you may consider consolidating into a direct consolidation loan to simplify your payments. But that all depends on your individual situation. We're also dropping in the chat a powerpay.org calculator that can help you. All right, so at different times in your life, we may save in different ways and for different things. Our need for specific financial tools to help us save may also change, especially as our financial goals and needs kind of evolve. You may not use all the saving tools that we have on the screen right now at the same time, but it's useful to be aware of them. The 529 savings plans and retirement plans leverage investing over a long period of time to help your money grow. So we'll talk more about those today. And then you also may be wondering, how do investment work? So ultimately, either someone pays you to use your money, like in the form of interest or dividends, or you buy something that could increase in value, like when you buy a stock in a company or you buy real estate, and then you hope that when you go to sell those items at a later date, they have gone up in value. And another thing to keep in mind is that people face different barriers when it comes to taking advantage of many different financial services and products. And we each come to investing from different places. So historically in America, African Americans and Hispanic and Latinos are less likely to be among investor households than other Americans, including Asian Americans. And that gap is narrowing, but it still exists. There might be other factors like education, employment status, financial literacy that can also influence whether people invest. For example, people with savings accounts and higher risk tolerance are more likely to invest. You may face barriers too. Perhaps your extended family hasn't been inclined to invest, or you've had bad experiences with investing. Often the lack of knowledge about investing is a barrier too. So participating in this webinar and following up on some of the resources that we provide is an excellent way to start overcoming some of these barriers. All right, so how long you have to invest to reach your goal determines what you should really invest in. So for example, for long-term goals, inflation is going to be your greatest risk. So investing and taking advantage of compound interest can help you reach your longer-term goals. For short-term goals, those that you're hoping to achieve within the next 5 years, for example, volatility may have the greatest impact on your ability to reach those goals. So you want to choose investments whose values won't fluctuate a whole lot in that case. The earlier that you start investing, the more time can help you take advantage of compound interest and the less contributions that you'll have to make when you start early. All right, I'm going to hand it over to Alan to talk about where to get started.
Okay, thanks, Andrea. Well, that is the key, getting started. And we often get questions, how do I get started? So let's take a look at that. So the easiest place is probably your employer. Many employers offer retirement plans that are known as 401ks. They're also known for nonprofit organizations as 403bs. For those employers that don't have a 401k, the Illinois Secure Choice offers a program. If you're not doing it through your employer, you have the option or ability to go to a large financial management firm that you often see advertised on television. You could open a non-retirement account in mutual funds, or you could open an individual retirement account there as well. And as well as a 529 savings plan for educational purposes. Other ways to get started are opening an account with a broker or brokerage firm, with an investment advisor. There are different kinds of brokers, discount brokers and online brokers. They're all very similar. They just differ in what they can offer you and what they charge. And then lastly, investment apps have gotten very popular, especially since the pandemic. And that allows you to use your mobile device or phone and to do investing on your phone. Robo-advisors are typically offered by investment management firms. And those programs often give you a combination of a computer-based advisor, but also some human contact as well. So let's talk about retirement accounts, because that's the way most Americans invest in the stock markets. They do it through their retirement accounts. I touched on your employer having a sponsored retirement plan. Again, that's your 401k. That's easy because the employer does all the work of investing for you. And so when you start, if they had one, you would choose the funds that you want to invest in. And then your employer pulls out your salary or income, which is going to be invested in the retirement plan. And so it's pretty easy to do. There are tax advantages because if you do a traditional 401k, your money is going into the 401k before it's taxed. So you're not paying taxes at that point. However, when you reach retirement and you want to take money out of your 401k, it will be taxed. The other option for retirement accounts, if your employer doesn't offer a 401k, or even if it does, you may be able to open an individual retirement account subject to some income limitations. These are, again, traditional or Roth. Traditional is where you put your money in before it's taxed. Roth, you put your money in after it's taxed. And with a Roth, since you put your money in after it's taxed, when you take your money out in retirement, it's not taxed at that point since you've already paid the taxes. You can do automatic, you can set up automatic investing for your individual retirement account. And again, gives you another option if your employer doesn't offer a 401k.
So I
So
just
I'm
want
going to go ahead, Andrea.
I was just going to jump in and talk about vesting real quick. I just want to really emphasize that vesting is something that you'll want to pay attention to when taking advantage of employer-sponsored retirement plans. This is when an employer offers to match your retirement contributions up to a certain amount, but you need to understand what the vesting requirements are in order to keep those contributions. So, for example, if the employer requires you to work with them for 5 years and you leave it 3 years, you don't get any of the contributions that they made towards your retirement account. So keep that in mind when you're trying to leverage employer benefits, just so you aren't losing out on money you thought you had towards retirement or other long-term goals. And I'll hand it back over to Alan.
So let me talk a little bit more about individual retirement accounts or IRAs because there the onus or burden falls on you to open the account, unlike a 401k where your employer has it and they're doing most of the work for you. So who can open an IRA? You have to have, the key is you have to have earned income. That means you actually have to have a job. So you have to have a job with salary to open up an individual retirement account. How much can you put in your IRA? The IRS sets the limit, and they typically raise that number every few years. It was just raised to $7,000. So you can, if you have earned income in that amount, you can put $7,000 in. If your earned income is less than that, you only can put up to your earned income. There is a bonus if you're 50 or older. They allow people who are 50 or older a catch-up contribution of $1,000. So if you're 50 or older, you can put in $8,000. There are some income limitations on IRAs. So if you have a high income and your employer also offers a 401k, you may not be able to contribute, but you have to just check that out to make sure that you're getting it right. There are different kinds of individual retirement accounts. There's a traditional, as I mentioned, where your money goes in before taxes. There's the Roth where it goes in after taxes. And then for people who are self-employed, there's the SEP and the simple IRA. We get the question, okay, well, what can I invest in my individual retirement account, or if I'm opening a non-retirement account and I want to invest in mutual funds. And what's become more and more popular are index funds. 20 or 30 years ago, you didn't hear too much about index funds. You heard mostly about mutual funds. Now, index funds have gotten very popular. And what are index funds? They are funds where the goal of the fund is to simply match the performance of an index or a benchmark, such as the Standard & Poor's 500. Unlike actively managed mutual funds, these are what they call passive management. So there's a management team, which is simply, probably using computers, matching the portfolio of the fund to an index such as the S&P 500. And they're not trying to do anything else other than simply match the S&P 500 or another index. Why have these become so popular? Well, a number of reasons. They provide diversification like other mutual funds, but here's the main reason: they often charge lower fees. So what are mutual funds and ETFs? They are an investment company that pools money from shareholders, investors like you and me, and then they take the money that they get from all the shareholders and they invest it in stocks, bonds, and other securities. As I said, mutual funds are the way that most investors invest in the stock markets. Most investors aren't Warren Buffett, where they're picking stocks and winners and losers. Most of us don't have time to do that because we have other jobs. And so mutual funds is really the good answer to do that. Mutual funds provide diversification because the fund is investing in hundreds of securities. They have a professional management team and affordability. If you want to open a mutual fund account, the typical base may be $250. So it provides a way to start saving without if you don't have a lot of money. You have to remember that the risks of a mutual fund are the same as the risks that the fund is investing in. So what does that mean? Well, if you've invested in a mutual fund that invests only in stocks and the stock market goes down like today, and you were to look at your portfolio the next day, you would have lost money because you're investing in stocks, and on days when the stock market is down, your portfolio is likely down as well. How are mutual funds and ETFs, exchange traded funds, different? Well, a couple of main differences. The big one is that ETFs, exchange traded funds, as the name sort of shows, they're traded on the exchanges like a stock. So if you wanted to buy an ETF, you would need to have a brokerage account and a broker, and you'd call your broker up, just like you might do for a stock, and you say, I want to buy shares in this ETF. And the broker will say, hold on. The broker goes to his terminal and puts in your trade. Then it comes back a few seconds later and says, you bought that ETF. Mutual funds don't work that way. Mutual funds, if you call your broker or investment professional up, they'll say, hold on, I put your order in. Mutual funds are purchased after the market closes, when all the large investment firms are journaling and trying to figure out the various positions and based on the trading that day. Is that a big difference? Well, for some people it might be. Having it traded on the stock exchange gives you certainty, and you know what you paid for the fund. Another difference is that mutual funds only disclose what they're investing in on a quarterly basis, 4 times a year. ETFs disclose what stocks or other securities they're trading in on a daily basis. So you have a better look at what's in the fund for ETFs. And the last difference that people find important is the tax treatment. Typically, ETFs have lower capital gains and thus lower taxes because they're trading less. And so they generate less capital gains, which ordinarily would mean taxes to individuals.
Okay, so now that you feel ready and have made the decision that you want to start investing, you need to consider the risks related to the different types of investments and then compare them to your individual investing goals and the associated timelines with those goals. And by investing goals, this could be saving for retirement, saving for college, saving to own a home, and building your own wealth. So the first rule of investing, all investments have risk. If someone tells you that this is a riskless investment, you can't lose any money, walk away. A lot of beginning investors are starting to use apps to become acquainted and familiar with how to go about investing. It's easier. Everyone has their phone with them. They can do it on the fly. But remember, when you are investing, especially on an app that allows you to make your decisions really quickly, don't let it turn into a game. This is real money. This isn't like playing, any other game on your phone. Instead, this is your money and your future that you are working with here. Don't let, either an app itself or social media or anyone else nudge you into investing more money than you want or investing in products where you could lose more money than you initially invested. Take care of your personal needs first. Don't invest something that you couldn't afford to lose. One other public service announcement, don't don't use federal financial aid funds or tuition money that you need to stay in college. It's not only a really bad idea, it's also illegal. Okay. So the biggest difference between saving and investing is the amount of risk that is involved. So you really need to start by figuring out how much risk you're willing to take on. We call this your risk tolerance. And there's a really important relationship in investing between the amount of returns that you're likely to get and the amount of risk involved. So in the diagram on the screen, you can see that in the lower left-hand corner, there is low risk, low return cash. This could include a money market account, a CD, or a regular bank account. You're not going to get much in the way of returns, but you're also not risking your principal that you put in. Then if you move up to the right a little bit, you can see that we're moving from the safer but lower return cash-like investments to the riskier but potentially higher bonds. This could include government bonds, municipal bonds, corporate bonds, or bond funds, and then all the way up to the right to stocks. And this would include individual stocks that you invest in, or stock mutual funds, or ETFs. And you can see, while stocks have a lot higher risk than cash, you also have the potential for a lot higher return. And so use cash for your short-term goals when you need the money much quicker. And if you have a long-term goal, like for retirement, you can afford to take more risk on. So this chart shows the performance of US large stocks. So this would be like the S&P 500 that Alan just mentioned, for almost 100 years. Now, you can see there are a lot of ups and downs on the chart. There's some very significant downs, like the 1929 stock market crash, the dot-com crash, the recent financial crisis and Great Recession. But if you have a long-term time horizon for your investments, you can also see it's mostly up. So even if there are individual down periods, the long-term trend of the stock market is positive, and the long-term average rate of return for the S&P 500 is about 8 to 10%. Oops, sorry, Andrew, can you go back to that? One thing that I just wanted to note, that if you have a long-term time horizon for your investments, you can see that you'll capture the historical averages of the market by holding on, not worrying about the daily fluctuations and the volatility in individual time periods. But look at each individual time period and you'll see kind of a mountain, that the shorter your time horizon, the more that the volatility of the market does become relevant. So if someone in 2006 planned to retire in the next couple of years, but kept all of their money in stock, they would have been seriously hurt in the 2008 downturn, and likely would have even been prevented from retiring at that time. So just teaches you that as you get closer to a target date, whether it's college or retirement, that's a really great time to be looking at your asset allocations and your risk tolerance, and reconsidering whether you're still in the same risk tolerance that you may have been when you were 30 years old or 40 years old. Okay, sorry, Andrea, thank you. So crypto assets are something that we receive questions on all the time. There are substantial risks that you should consider if you are considering investing in any type of crypto asset. First, these are relatively new and untested investments. even Bitcoin is only a little over 10 years old. Novel investments with limited track records often include quite a bit more risk. Unlike being able to chart back 100 years for stocks, we can't do that with crypto assets. Another risk is that cryptocurrencies are speculative. Buyers are hoping that someone will pay more for their assets than they did, but there's a significant chance that they could lose their money. It makes them different than like a share of stock in a company like Amazon that has revenue streams, customers, warehouses, software, trucks driving all over the place. Those things have intrinsic value themselves, not just speculative value that depends sometimes on people's whims. Digital assets and exchanges also don't have the same investor protections as stocks, bonds, and other securities or securities players. Digital investments are largely unregulated right now by agencies like the SEC. And while that could change in the future, they don't have the same level of investor protection as you would expect in investments like a stock or a bond or fund or the funds that you have in your 401k. And that presents additional increased risk. So Making Sense of Money has a number of podcasts involving crypto assets that you can reach through the link in the chat. If you're interested, please check them out. There's also information about crypto assets on the SEC's investor.gov website that you can look to for straightforward information. Another question that we get, especially from people who use investing apps, is whether they should buy stock on margin. So buying on margin essentially means that you're borrowing money from the brokerage firm and using that money to buy additional shares of stock that you may not be able to afford with the money that's in your brokerage account. Like any loan, you have to pay the money back. But unlike a regular loan, the time for payback could be accelerated if the value of the stock drops. And then you could end up owing more than the securities originally cost you because you also have to pay back fees and interest. Short selling is another thing that we get questions about. I'm sure everyone has probably seen this. It's been in the news over the last few years. So a short sale generally involves the sale of a stock that you don't own, that you're going to borrow. Short sellers are essentially betting. They believe that the price of the stock is going to fall. And so they are trying to acquire it in order to bet against it. They also could be hedging against volatility in other securities that they own. If the price of the stock drops, short sellers will buy the stock at that lower price, hand the stock over, and then make a profit. But if the price of the stock rises, the short sellers will have to acquire the stock at that higher price, and they will incur a loss. And short selling essentially exposes an investor to potentially unlimited losses because a stock could theoretically just keep rising. So say you believe that there's going to be a decline in the stock price, and I don't want to call out any company, so I'll just say company A. Company A is trading at $60 a share. So you borrow shares of company A stock at $60 a share and sell them in a short sale. Later, stock price declines to $40 a share. So you buy those shares back on the open market to replace the borrowed shares. Since the price is lower, you profit on the difference. In this case, $20 a share minus your transaction costs. But what happens if instead of going down $20 a share, the stock price goes up to $80 a share? Now you have to buy the stock back on the open market at $80 a share, and you lose $20 per share, plus all of the transaction costs. So shorting the stock essentially is leaving you open to potentially unlimited losses. I know there's been a lot of social media traffic about people making money by buying and selling securities on a daily or every couple of days basis. So short-term trading is essentially buying and selling securities quickly instead of buying and holding onto them. It is subject to manipulation. I think you've seen meme stocks in the news where people are essentially just blasting social media about a certain stock. And the people who get in really early when the stock price is low may make some money, but the people who are getting in just a fraction of time later could lose a lot of money. Short-term trading in a volatile market really can lead to significant losses. So there's a Library of Congress study of investing behavior. And what it actually showed is that active trading or trying to time the market generally results in underperformance of the market itself. There are a few reasons for this. First, we're human. Investors tend to hold on to losing investments too long and sell their winning investments too soon. We also have a tendency to follow trends and overreact to both good or bad news in the market. And remember, every time you buy and sell, you might be charged a fee, which ultimately will reduce your long-term performance. And we're going to talk about that a little later. Another risk of trying to time the market is that picking just a few stocks that you hope will be winners could leave your overall portfolio with very little diversification. Instead, you're picking just one stock in a particular area instead of purchasing an ETF or a mutual fund, which will have most of the stocks in a particular area and help you diversify in case there's a problem with just one of those individual companies. If you move money in and out of the stock market, the studies have shown that just missing just a handful of the best days where the market surges, like we've been seeing lately, could severely impact your long-term return. Instead, if you have a low fee, diversified, long-term buy and hold strategy, you can better assure yourself of capturing the best days in any given period and weathering the worst days. And remember that there are other ways to participate in the market without attempting to pick winners or time the market. And that's investing in a diversified portfolio through your workplace 401k, mutual funds, or ETFs. So once you invest, you also should be aware of how or if you can lose money. Remember that you don't actually lose any money until you sell your investment. But as we saw in the earlier slide, the market fluctuates up and down in any given period. So how can an investment lose money? One is company risk. A company's competitors could be better at doing their job. And if you're invested in just one single company instead of the industry as a whole, you could run the risk that somebody else in the same industry does it better than the company that you invested in. Same thing, consumers may decide that they don't want a particular product or service. I think we've all seen that there are companies that highly specialize in one area, and then new technology makes that area somewhat obsolete and nobody wants it anymore. That puts that company at risk. I think a lot of things that people were interested in during the pandemic are no longer interested once people are not spending all of their time in their houses. Another thing could be the company isn't well managed. Management spends money that they don't have and can't make it up with what they're selling. Sometimes fraud. Someone running the company isn't honest, and that means that either they're stealing money from the company, or worse, they're selling you an investment that is a fraud. And then finally, be careful, because if you need money in the short term and you have to sell your investment when the market is down, you can lose money. You have no control over what the market is going to do on an individual day or in an individual week. Okay, there are other risks. I'll run through these pretty quickly, but there's geographic risk. I think everyone can relate to the war in Ukraine, and it can provide a risk to energy prices. There's also an emotional risk to investing in it. The economy itself, I think we've seen that the last few years, this market has been pretty volatile. And in an individual time period, you cannot guarantee what's going to happen. And then, as we talked about a little bit, competition impacts individual companies. Sometimes there are regulation changes that impact a particular industry. And in social media, there is not much regulation for information sharing. And so people can talk about a company in a particular way, either positive or negative, that doesn't really reflect the company's balance sheet or its particular prospects at the time. Okay, I will turn it back to Andrea.
Thank you so much, Anne. So we've talked about kind of having a financial plan. We've talked about ways to get started investing. We've talked about risks of investing. And now we're going to talk about some investment strategies. So one of the things that we talked about earlier was risk tolerance. And it varies from person to person, and even sometimes across our lifespans, it might vary. And there's some research that shows that younger adults and men tend to be a little bit more risky when it comes to investing, but that's just a trend, and it might not describe your situation or my situation. So some researchers at University of Missouri developed this quiz to help you identify what your own risk tolerance is if you haven't really thought about it before. So don't use this as a guide, but rather something to inform how you approach investing or how you talk about your goals and tendencies with a financial professional or a broker or whoever is going to be involved in your investment activities. Another thing to keep in mind is most of us don't really think anything of automating payments to our utilities company or our insurance company or monthly subscriptions to entertainment or streaming services, but we can apply that concept to saving and investing too. So it helps kind of to do your saving and investing automatically, so you aren't having to actively think about it a whole lot. You can set it up with your financial institution to have money sent directly to a savings account or investment account, such as a mutual fund account or IRA, like what Alan was talking about earlier. This creates the habit of saving and allows you to take advantage of the power of compounding interest to work for you over a longer period of time. This slide, where we're showing an example of compounded interest of automating $75 of an investment per month at 5, 10, and 20 years, assumes a 7% annual rate of return, and we use the investor.gov compound interest calculator to come up with this. But just keep in mind that, of course, stock market returns can vary greatly year to year, so we're just using that as an average. And I'm going to hand it back over to Alan to continue our discussion of investing strategies.
Okay, thanks, Andrea. So we've talked about that all investments have risk, that it's important to invest if you want to keep ahead of inflation and do better than that you can in a bank. And so the two main ways to deal with investment risk are diversification and asset allocation, otherwise known as don't put all your eggs in one basket. So let me start with asset allocation. That's where you have your portfolio or your little bucket or your pie chart, and you decide how much you're going to put in each of the main asset classes. So that would mean how much of your portfolio is invested in stocks, how much of your portfolio is invested in bonds or fixed income, fixed investments, and how much is in cash. Now, the driver of that really are really two factors. One is your age and your retirement time. If you're younger and have a long time until retirement, and so you won't need your money for quite some time, then you're in a position to take on more risk. And as we've seen, the longer you can invest, your investment can therefore deal with the ups and downs of the market. On the opposite side of that, if you're someone who's nearer to retirement, you want probably a more conservative portfolio because you don't have as much time for your portfolio to deal with the ups and downs in the market. It's really important to keep, whatever your age, to keep some amount in cash as an emergency fund because you never know what's going to come about, whether a car problem or a house problem. And there have been studies shown that typically Americans don't save enough and don't have enough for even a repair that could be $1,000. So having an emergency fund is really important. Now, the other way I mentioned to deal with risk is through diversification. And that's where you take one of your asset classes, and the easiest one is to look at stocks, and you divide your stock portfolio between different sectors or stocks or funds in the market. So here, our portfolio is divided between pharmaceuticals, finance, aerospace, energy, and agribusiness. And the reason why diversification helps is because if any of those sectors are down, let's just take pharmaceuticals, the drug companies. If that sector is down for some reason, the hope is your investments in the other sectors will do well, and on the whole will bring you up and sort of as a counterweight to the sector being down. Another way to deal with some of the risks of investing is through what's called dollar cost averaging. And this actually is a way where you set up an investment program where you set it up so the same dollar amount is being taken out of your checking account or your salary and invested in the market on a regular basis. Let's just say once a month. Now, how does this work and what's the advantage? Well, what happens is if you're automatically buying an investment in the market every month, you're whether you know it or not, you're buying stocks when the market is up and when the market is down because you're buying it every month without doing anything. And the advantage there is when you buy the market when the stock market is down, you're getting what is commonly called stocks on the cheap because prices have gone down. And that allows you to buy more shares when prices are lower. You may not realize it, but you're actually doing this if you have a 401k. Where you're making investments in the market on the same amount at the same time as your paycheck comes out, and so that's happening with your 401k. So it's a good way to basically deal with some of the risk in the market. Let me turn to investment fees. It's really important to monitor fees. The good news is that compared to 20 or 30 years ago, when not much about fees was known, there wasn't much transparency. Now there's a lot of competition we see in the marketplace with financial firms lowering fees because they want customers. And the thing you need to really be aware of about fees is that fees eat up your returns over time, right? They're taking money out of your portfolio that otherwise could be going into investments, but they're paying fees. So if you assume two investments have the same rate of return, the one with the lower fees is going to grow faster, right? Because more of the one with lower fees is allowing more of your money to compound and work for you rather than for an investment firm. Now, we talked a little bit about index funds and actively managed funds. Actively managed funds are where there's a management team and researchers who are doing lots of research and studies to try to find funds that are going to beat the markets. And they typically have higher fees than index funds or passive funds because they have a whole team of people who are doing lots of research and management trying to beat the market. What's the takeaway? it's really important to compare fees when you're choosing your investments. So if you were lucky enough to come into an inheritance or a gift, and you're trying to decide, what fund or ETF to invest it in, it's really important to compare the fees because, as we said, lower fees take less bite out of your portfolio. There are lots of places to turn to researching funds and their fees. One good place is the FINRA Fund Analyzer. It's a tool that allows you to compare and research up to 30,000 mutual funds and ETFs. FINRA is a regulator of the securities markets that we regulate. So it's a nonprofit, and it's a reliable and cost-free tool. But there are other ways to research as well. It could be through an investment service like a Morningstar, or it could be simply on the financial firm's website. What we discovered was that we could do a really simple chart to show the impact of even a fractional difference in fees. So we set up this hypothetical investment where we have three investors: the blue investor, the red investor, and the green investor. We gave each investor $100,000 and we invested it for 20 years. And the only difference in the investments was the fee being charged. And so the blue investor had the lowest fee, which was a 0.25 annual fee. The red investor had a 0.50, and the green investor had the highest fee, which was a 1% annual fee. So not big differences, but after 20 years, the blue investor with the 0.25 percentage point fee had $30,000 more than the green investor, who had the 1% fee. So if you look at that, that 0.75 percentage point in fee resulted in a $30,000 difference, right? So if you had an investment professional who said, well, this one isn't that much more, it's only 0.75 percentage point. Yeah, it doesn't sound like much, but the bite that took out of the portfolio over 20 years was $30,000. And I think we'd all prefer to have the $30,000 than to go into the investment firm. So the takeaway here is research fees, make comparisons, and make sure that you're buying a fund that has a low fee but also has performed well. Okay, as we said, we can't provide investment advice, but we can talk about some of the things to avoid when investing. Trends are really one of the big things to avoid. So an example of that was the meme stock popularity during the pandemic. What typically happens with trends and why they're one thing to avoid is that you tend to be aware of the trend, like the meme stocks, well after everyone else does. And so you get in late, and at the time you're getting in, that's when everyone else is getting out. And you end up buying high and selling low, right? And that's not what we want to do in investing. We want to buy low and sell high. Another one is short-term trading, or trying to time the markets. Anne mentioned this, and it's difficult to do well when you're trying to time the markets, when the markets can be up and down and very volatile, and no one knows when that's going to happen. And as Anne mentioned, the Library of Congress study showed that people who were active traders tended to underperform how the markets were doing overall. And that's because it's impossible to time the markets and know when the market is going to be up or down. We like to say that it's more important to be in the markets and your time in the market rather than trying to time the market. And the last one is the old FOMO, the fear of missing out, which we know what that feels like. It can happen in lots of different ways. But it can particularly be a little painful when you hear about everyone else who's investing and making a lot of money, and you feel you're the only one. Again, this is like trends, because what happens is our emotions take over. We don't want to miss out. We hear our friends are investing and making a lot of money, but by the time we jump in, it's after everyone else has done that, or most people. And again, you end up buying high and selling low. One good way to sort of see what these trends can do, and an example of sort of a phony investment operation is on the SEC's investor.gov web page. It's called the Howey trade. And I would suggest you all take a look at it to sort of raise your alerts and your radars to some of the red flags for an investment fraud. Okay, things to remember while investing, and this is sort of your, sort of checklist of things we've talked about and things that really matter. So compound returns really matter, right? Compounding is how our investments grow. And again, that means leaving our money in the markets for a long term. Diversification and allocation, really important. It's the don't put all your eggs in one basket. If one sector goes down, you're invested in other sectors, which will hopefully pull up your investment. Keep costs low. Again, that's really more possible today than it was 30 or 40 years ago when we knew less about fees. Today, it's really easy to compare fees and to make sure that we're investing in something that's growing for us and not for our financial professionals. Invest regularly. We talked about dollar cost averaging. But most importantly, that means taking advantage of your employer's retirement account, their 401k. And most importantly, remember, if what you hear from an investment professional sounds too good to be true, it probably is, and walk away.
Okay, I know we're running a bit behind here, so I'm going to move through the next couple of slides very quickly. But now that we've talked about the types of investments, the risks of investing, how do you go about protecting your assets? Let's focus on a few important concepts to keep in mind so you can protect yourself and plan for the long term. Look out for red flags of investment fraud. This is what I do on a day-to-day basis, but often by the time something comes across my desk or anyone else in enforcement's desk, a sizable portion of the money is already gone. So the best thing to do is to learn how to protect yourself. And here are a few ways to do that. We have found that investment frauds tend to have certain commonalities. One of the most common tactics is to promise terms that are too good to be true. There's zero risk, huge guaranteed returns that beat anything that you could get in the stock market. Don't fall for these claims. That's not possible. Another thing that some fraudsters will do is attempt to pressure you. Think of an unscrupulous used car salesman telling you that you have to buy right now or the price is going to go up. No legitimate investment will ever require a rash decision. And if they don't give you something in writing, like a prospectus or an offering memorandum that tells you how your money is going to be used and exactly what they're going to be doing to get a return for you, walk away. So there was a survey a few years ago by the FINRA Foundation, and it found that 8 in 10 people who responded to the survey had been solicited to participate in a potentially fraudulent offer. 16% of those people actually invested money in at least one of the fraudulent offers. Another 11% lost a significant amount of money after investing. The research also showed that on an average basis, fraud costs Americans over $50 billion each year. So here are some of the most common types of fraud on investors. I'm not going to go through everything. You can find more information on each of them on investor.gov, but a few things to watch out for. Affinity frauds are frauds where someone who shares some of the same characteristics as you, whether it's the same ethnicity or heritage, or you both have military affiliation, you go to the same church, you're in the same profession. Something along those lines where there's a common characteristic and they play upon those similarities to get you to trust them and invest with them, and then they defraud you. Ponzi scheme is a very old scheme that continues to this day. And essentially, all it is that the fraudsters will use later investor funds to pay off the earlier investors and keep the scheme going. The scheme collapses when the fraudsters can't get more new investor funds or enough new investor funds to pay off the older investors. And one of the biggest problems is you never know where you are in the continuum of investors. Similarly, promissory note schemes. You give money over and the fraudsters say they will pay you back your principal with interest. But oftentimes they have no way of generating the interest, and instead they just take your principal. Microcap fraud, there's been a lot of that on internet and social media. Invest in this penny stock. But what they don't tell you is the penny stock actually has no operations, no way of making money. And the only people making money on it are the people who got in a long time ago for fractions of pennies and are selling their stock to anyone that they're trying to get to invest right now. Check out investor.gov. It'll give you some more information. Okay, I'll turn it back to Alan.
Okay, so at the beginning, I think Andrea pointed out it's important to have a financial plan. And one of the most important things of your plan is deciding early on what kind of financial firm, what kind of investment professional do you need? And this really involves asking yourselves a lot of questions. Are you the kind of person who likes to do it yourself? Are you going to want to set up an account and do your trading in mutual funds or stocks on your own? Are you someone that wants to have the old style full service investment firm where they manage your portfolio? They decide what they have your discretion, which means the authority to decide what you're going to invest in. Are you someone who wants to have not quite your do-it-yourself, but someone that you can talk to every so often? Are you someone who wants a robo-advisor where, you know, a computer for the most part or a computer software is determining what you're going to invest in based on your age and other things related to that? These are all important questions because you want to make sure you're not paying for things you don't need, and you want to make sure you have a firm and a setup that works for you. I talked about costs. But part of that is when you're deciding on what kind of account or financial firm you need is to think about the costs. If you want a firm that's going to do it all for you, that there are going to be more costs involved. If they're determining what you're going to invest in, they have more people assigned, that can be quite costly. If you're a do-it-yourselfer, there are lots of online firms that you can set up an account and actually do it pretty cost effectively. Again, you need to decide that from the beginning. And one of the key things to do is whichever kind of firm you're going with, make sure from the get-go that you know what the costs involved are. There are different kinds of costs. There are annual charges, commissions. There are fees based on investing portfolios. The key thing is to ask what you're being charged and what you're getting for what you're paying. It's really important when you're going through that process of picking an investment professional to do a check on them to make sure that they are licensed or registered. We have a tool on our investor.gov page on the homepage. You can see it right there, right below investment professional. And it's where you can put the professional's name in to make sure they're licensed or registered. Why is that important? Because anybody who is providing investment advice or buying and selling securities has to be licensed or registered by both the SEC or the FINRA, the organization I mentioned, and at the state level as well. So if there was somebody here who was trying to sell you a security and they're operating in Illinois, that have to be licensed with the state of Illinois as well as with the SEC. Our tool not only has whether the person is licensed or registered, which is the first key determination, but it also has their employment history, so you can see whether they've jumped around from firm to firm. And it will also have other important disclosures. For instance, if they had some kind of criminal action against them, if they had lots of customer complaints, if they had regulatory actions by regulators, if they filed for bankruptcy, all things you'd want to know if you're hiring someone to manage your nest egg. It's not only important to research the investment professional, but it may be important to research the investment that you're considering or being sold. Again, why is that? Well, most securities are required to be registered with the SEC. We have a page on our website. It's an acronym. It's called EDGAR, and it's where all the filings of registered public companies are listed. So for instance, if you wanted to check out a public company because you were curious, you could go into EDGAR and you could find all their annual reports and quarterly reports. So you could it's a heavy load to read, but you can get a sense of what they're doing. If you look up an investment that someone's trying to sell you and it's not an EDGAR, that's a red flag that something may be amiss because most investments are required to be registered and to therefore would be in our EDGAR system. Really important to protect yourself and to make sure your portfolio is not at risk. How do you do that? Really very simple. Ask questions, ask questions, ask questions. You actually have the right to understand. Again, you're trusting somebody with your life savings, with your nest egg, and you can't be afraid to ask questions. But you need to have your radar up. It's important not only to ask the right questions, but to listen. And if something sounds amiss, something sounds too good to be true, get up and walk away, or at least go and do further research to determine whether you're going to come back. Really important to evaluate and modify. What does this mean? You know, we get questions from people, how often should I check my account? Should I be checking it every day? Should I be checking it, every week? Well, that can get a little crazy when the markets are up and down, but it is important to check it at certain timeframes. And it's really important to make sure that that plan that you set perhaps a couple of years ago still makes sense. Does your asset allocation still match where you are? What typically happens for people over time is that as the markets go up, their allocation among assets gets a little out of whack or out of balance because they have too much in their stock portion. So it's really important to look at on some level, some periodic basis, look at how your investments are doing, look at your allocation and make sure that it makes sense for not only where you are at this point in time, but also it makes sense for how many years your retirement is going to be upon you. We have lots of other good financial planning tools and resources on investor.gov. Two of them are the required minimum distribution calculator. I know many of you are too young to have a 401k or an IRA where you're required to take money out because that happens at age 72, but that calculator can help you figure out when you have to do that. And the most popular page on investor.gov is our compound interest calculator. And it's a good planning tool because it can help you determine what you're saving, what your goals are, and how much you have to save in order to get there.
All right, so thank you for those of you that are still on. If you want to learn more about investing, you can go to investor.gov, watch some of our previous webinars, listen to some of our podcasts on investing, or you can even use simulations to learn more about investing, like the stock market game or MarketWatch's virtual stock exchange. Today we covered a lot of information. We went a little overboard, I think, with our content, but there's so much to know about investing. We want to remind you that it's important that you have your goals laid out, you know your financial goals and timeline. You want to focus on investing for the long term, especially if you are younger. You also want to understand how inflation can impact future purchasing power. You also want to understand some of the risk of investment losses or potential losses along with the potential returns. You also want to use principles of diversification, low cost fees, and regular investing as strategies to maximize your potential returns over the long term. And you want to protect yourself against significant losses and fraud. Our next webinar is Save Money on Food, which is on March 6th. If you haven't signed up for it yet, Steve has been gracious enough to put all the links in the chat. We apologize if they haven't been working for you, but hopefully when we send out the follow-up email with the PDF of all these links, they will work. We will double check. They all worked yesterday, but something's happening. So we will make sure that they work when we send them out. If you want to watch previous webinars, we have them all on YouTube. If you go to IL Student Money's channel, you can also get there by going to this short URL. And you can stay in contact with us. If you do have questions that you want to get answers to later, you can email studentmoney@uillinois.edu. That's the email that sent out the login instructions for today. And we'll stick around for a couple questions. I think that most people had the question of why aren't these links working in the chat, but hopefully we'll fix that when we send out the follow-up email. We already have a good question that I don't know if any of us can answer. It says, how is it that Social Security and are taxed in most states, but you can't use pension money to contribute to an IRA? That's a pretty specific one. Alan or Ann, do you have any insights?
I'm not sure I understand the question, but so do they mean pension money that you might have from a job?
I assume so. If you can restate that question, it's a little confusing.
I mean, there are in some cases pensions that you might have from a private employer that again, it depends upon the pension and the rules of the pension. Some of them may allow you, if you, I guess, leave or retire, to take your pension as a lump sum, and then you can roll that into an individual retirement account. But again, it depends upon the how that's organized and the rules of that pension. But in some cases, that is possible.
And I guess the other factor might be it being considered earned income, or if you aren't working at the same time, that could impact it. It's not considered earned income if it's a pension payout, right?
I mean, it depends. Certainly, that's why I
Yeah.
said it's hard to give a complete answer because it does depend. But again, there are some pension funds that where you've vested in the pension, and that means you're going to get it at retirement unless you take it before. And you generally can take it as an annuity, or you may have the option to take it as a lump sum. In that case, you may be able to roll the lump sum into an IRA. But again, you'd have to make sure you understand the terms of the pension.
All right, thank you. We do have another question that I don't think we can provide a lot of guidance on, but they're asking, do you have any guidance on targeting funds that are socially responsible? For example, they'd like to focus on ESG funds. We've actually written a blog article on ESG funds, kind of explaining what they are and some of the research on them. But we're kind of limited in what we can say through the Student Money Management Center. Alan or Ann, if you wanted to provide any other insights.
I'll jump in. I mean, so we also have some resources on investor.gov that talk about socially conscious funds. And again, that certainly depends upon the individual, what's important to them, what they want to invest in. And so, they're there and you generally can find them. And so I would say that approach them the same way as you would approach any other investment. Why is that important to you? What is the charges? What's the return? That's how I think would be the best way to approach it.
Steve or Emily, were there any earlier questions that we should try to address quickly?
I don't think so.
All right. Well, we'll wrap things up for the recording today. We'll make sure to send it out after it's been appropriately captioned. If you think of questions or follow-up questions that you would like to get an answer to, we'll do our best if you email studentmoney@uillinois.edu. And thank you again for joining us and sticking with us even after the hour it was up for this webinar.